Hello, Business 330, Business Finance Online students. This is Professor Hassey. It's Wednesday, October 21st, and I'm posting our video to replace our class lecture last evening due to a family emergency that I had. And again, I apologize for that. I'm just going to go over a couple brief things this evening, and then we'll talk a little bit more about it next week in our introduction video and our in-class online class next week. But a couple of things to look at: definitional, a couple of calculations to understand the meaning. Assignment number one, I'm still getting some students posting number one, so I will post those grades and solutions as soon as I receive all the assignments, which will probably be in a day or so. So look for those grades over the weekend for your assignment number one. First of all, I'd like to start off with, let's go to our Blackboard. And here in our Blackboard, if you go to student discussions, there's some graded work for you to do this week. It's to update your portfolio. As of Friday, October 23rd, update the prices, update the valuations of the portfolio and the Dow, the S&P 500, and the NASDAQ indexes as of Friday. And then something a little bit different, determine the percentage change in your portfolio and in the indexes from your original valuation of October 2nd. Then add a column and locate the beta of your company. And this we'll discuss in our class a little bit this evening, but also more in detail next week. The beta, the risk of your company. So here's my portfolio of this class, my original portfolio. This is how it looks, and this is how yours should have looked a couple of weeks ago. Notice the spreadsheet. I have the companies that I selected, the dollar amounts invested in those companies, the shares purchased, which is a division of the price into the dollar amount to give me the number of shares rounded to the nearest whole number, and then the indexes as of October 2nd. So what I would do if I were you is I would just take this section and copy it, Control C, and copy it down here. Oops, sorry, hit the wrong key there. Oh, got to do it again. Copy this section, Control C, and copy it here, Control V, and there we go. And now I would change the date to October 23rd. That's this, October 23rd. That's this Friday. Copy that down. And the next thing I got to do is remember, from my original portfolio, I had a formula here. Price divided into the investment. And that formula is still here. Well, I don't want to do that anymore because my shares value is going to be set for the entire term of our class. So what I want to do now is go up here and take these cells and copy them, Control C, or copy them, and bring them down here and go to paste values. So I just want to paste values. And notice, if you go to those cells now, the formula is no longer there. It's just the value of that number from here. No formula, there's the value. And notice it's quite a long decimal number for each one. That's why we round to the nearest whole number. So now I have the correct amount of shares that I had in my original share calculation. And now let's say Apple Computer goes up to $115 on Friday. This is hypothetical. Let's say PayPal goes down a couple of dollars. Let's say Peloton goes up to $110 and Xiaomi goes to $12. So those are the prices as of Friday. So now what I want to do is I want to take in this cell my price times the number of shares to get my new valuation. So equals this cell times this cell. And now I have my new value. It's still based on the actual shares of above, but now I have the formula here in this cell, and that's what I want to see. The new price of October 23rd times the shares equals the new price. So let's copy this down all the way. And there's my new valuation. Ew, not a very good couple of weeks. Now, again, this is all hypothetical. It'll be the actual price of October 23rd, but the format is the same. So notice I have lost value. It's gone from 100,000 to $97,000. All right. So now right here, what I do is I'm going to put a formula in here. Equals, parentheses. I'm going to take this number minus the October 2nd value, which is 100,000, put that in parentheses, and then divide it by the October 2nd price, G11, and hit equal. And I get a decimal, and I go up here and convert that to percentage, go out 2 decimal places. So I lost 2.95% of my portfolio value from October 2nd. I want to see that. Percentage change. Dollar change, it's pretty obvious. Percentage change located next to it. So when I say, how'd your portfolio do the month of October? Oh, not very good. I lost almost 3%. You could say, well, I lost $3,046, but I lost 2.95%. You do the exact same thing for the indexes. Find the index value of October 23rd, right there. Then do a formula down here, taking the index change from the original and dividing it by the original amount to get the percentage change. Difference between the two numbers divided by the original amount to get the percentage change. My portfolio went down 2.95% from its original value. What did the indexes do? And I'd like that down here for each index. And then I can ask you, did you beat the market? All right. So I need the percentages to get full credit for this assignment. And then since we already have because I knew this was coming, we already have a column created, we can just go here, beta. And now I want you to go to Yahoo Finance or Google Finance or any other financial site. And right on the front page of the company's section on Yahoo Finance, it gives the beta for the company as of its current beta. It's usually between 0.5 and 2. And that's the beta. And you'll put that beta here, go to 2 decimal points, and I want to see that beta for each one of your companies there. What that means, that's the risk of your company in the market. 0 beta is risk-free. No company has a risk-free beta. Average risk is 1.0. That's the beta for the S&P 500 is always 1. That's the average market. We're comparing your company's performance over the last 4 years, 16 quarters. In some cases, it's 5 years. Comparing your company's return to the market. And that's what that beta calculates. If the beta is over 1, it means this company is a little bit riskier than the market. If the beta is under 1, meaning the company has performed better than the market. And that's what we want to see, the beta for your companies. So that's what I want to have you do. Take your existing portfolio, copy it down, change the dates, make sure these shares are in values down here, and then find the new price and multiply it by the shares to get your new valuation, and then find the percentage change for your portfolio and for the 3 markets. That's discussion post for this week for 5% of your course grade. Post this file to your forum in that discussion. So that's our work in the discussion post for this week. There's no other graded work to be done this week. You'll have an assignment next week posted during class next week. The only graded work this week is this discussion post number 2. If you go to week number 4 now, you'll see in our week 4 file folder a spreadsheet. Week 4 in-class review, and I'd like you to review this with me now. This is the spreadsheet I was going to review in class. So let's bring up that spreadsheet. There it is right here. And it takes a look at a couple of definitions of bonds and stocks. Remember, a bond is debt. It's called an obligation, where the obligation is an investor lends a company $1,000. Bonds are in $1,000 face denominations. And in return for getting the $1,000, the company agrees to pay that $1,000 back at maturity plus interest. And the interest is called a coupon. And that coupon is either paid semi-annually or every 6 months or annually, once a year, for the life of the bond. And this is what's attractive to both the investor and the borrower, the company, about bonds. You know exactly when you have to pay and how much. There's no ifs, ands, or buts. You know the cash flow requirement. You know that the bond is due at a certain time and you got to come up with the principal. You know the bond has interest payments payable at a certain time. You have to meet those obligations. It's pretty easy. For an investor, it's called a fixed income investment. You know exactly when you're going to get paid. For the borrower, a company, they can set their cash flow requirements and their budgets to meet the needs of that bond. A 30-year bond is issued with a face value of $1,000, paying interest at $60 a year. All right. If market yields increase shortly after the bond was issued, what is the bond's coupon rate? Well, first of all, the face value means that's how much you're borrowing or you're lending. Face value. Remember I said all bonds are in $1,000 excuse me, denominations. And if it's $60, that's 6%. $60 is 6% of 1,000. So that's the bond's coupon rate, 6%. So if somebody says, oh, I just invested in a $1,000 bond at 6%, that means you're going to get a check every 6 months throughout the life of the bond. Now, it doesn't sound very exciting, but here's the nice thing about it. You know when it's going to happen. That's the difference between debt financing and equity or stock financing. Equity finance, there's no plan. You issue and purchase stock, some quarters you'll get a dividend, other quarters you might get nothing. And you're not guaranteed if the stock to make money or not. It's a crapshoot based on the performance of the company relative to the market demand in the stock market. Bonds are fixed income. And if a company misses an interest payment or doesn't pay the principal on a bond, they immediately go into what is called default, bankruptcy. And they have to sell assets immediately to meet that obligation. So if I buy a bond, a corporate bond, or if I buy a government bond and the government or the corporation cannot make their interest payment to me or their principal payment at maturity, they immediately have to sell assets to generate cash to pay me off. It's called default. You're at the top of the list if a company gets in trouble. You get paid first. That's nice to know. That's why bonds are very attractive. Also, there's a great representation of bonds talked about in Chapter 9. It's about how interest rate affects the value of the bond. In other words, if interest rates go up in the market, let's say I buy a 6% bond, and the interest rate in the market all of a sudden go up to 7%, inflation, cost of money, whatever. That bond is still a 6% bond paying 6% interest, but the value of the bond will go down in the marketplace to $877.22. That's the present value of a 6% bond in a 7% market. And vice versa. If my 6% bond is now in a market of 5%, the bond has a price of around $1,151. Interest rates have gone down. It makes this bond more attractive with a 6% coupon. Thus, it's at a premium. It's worth more. Bond is at a discount when the market yield is over the coupon rate. Now, I'm not going to ask you to do these calculations. They're immaterial. But what's material about this is that the value or the present value of an asset decreases if interest go above payout rate. And the present value of an asset increases if interest go below payout rate. Assets' present value are determined by the market they're in. A 6% bond in a 7% market loses value. A 6% bond in a 5% market increases in value. And that's a very important concept in finance. The interest drives the value of the asset, present value, especially in credit or debt securities. Now, most people buy a bond and they hang on to it. The reason why they bought the bond or invested in a bond is because they wanted to receive that fixed income, no matter what. But at the same time, sometimes they have to sell it in the market. Just like stock, they have to sell it in the market. Well, the market will dictate the value of that bond in comparison to the actual payout it's paying. And this is called market yield. So if somebody tells you, hey, the market yield is higher than the coupon rate, then you'll say, oh, okay, it's worth less. It's at a discount. If the market yield is below the coupon rate, oh, it's at a premium. It's worth greater. The present value of an asset is valued at what the market dictates its present value is. It's like that in real estate. It's like that in stock. It's like that in everything. And the reason why this is important is because in another week, we're going to be looking at the present value of assets in the marketplace in comparison to the cost of the money to attract those assets. And this is an important concept. You don't have to be concerned about the calculation of this calculation. You will be next week, but not now. But I need you to understand the relationship of the future value and the present value. The present value increases if interest drops. Money is cheaper. My asset has a greater value. The present value decreases if the interest goes above inflation. Money is more expensive, thus my present value is decreasing. That's a very important concept. And then the next tab here talks about stock. Stock is an equity investment, right? It's an equity investment. You're owning a piece of the future, whereas a bond, you're a creditor. A company is borrowing the money. In stock, you're an owner. Where do you get your money in stock? The future performance in the market of the company, plus a dividend. And there's a great model talked about in Chapter 7 called the constant growth model. You can determine the present value of a stock relative to the market if you know certain key things about the company. And the key things about the company are given to you by the company every quarter. They have to. A publicly traded company has to tell you what they anticipate growing at, what their dividend is going to be, and what investors demand of them in the market. So here's an example. A company currently pays a dividend of $1. They anticipate a growth rate of 4%. In other words, we anticipate the company to have a 4% profit in the next year, growing at 4%. And investor demand in the market right now for us is 12%. Well, if you look at this current price rate here, this is the constant growth model. It's a formula that can give you the present value of the stock based on the anticipated dividend and growth and demands by the market or the investors of this company. And it's simply the dividend in year one divided by the expected return, or in this case, the discount rate, and the growth rate of the company. The company is paying a dividend of $1. It's going to grow at 4%. So at the end of year one, the company is going to pay a dividend of 4% times one, $1.04. $1.04 divided by the difference between 12% and 4%. 12% and 4%. The investors expect 12% return. We'll get into that calculation in a couple chapters. And the company has indicated in their prospectus or their planning a 4% growth. The difference between those two numbers is 8%. What's my stock price, present value? $13 a share. That's how I got this number here. Dividend at the end of year one, projected, divided by discount rate or investors' expected return, projected, minus the growth rate of the company, projected. Notice the word projected is used in a lot of this. $13 a share. That's the present value of the share based on the company's projections. But if I go to my broker or go to Yahoo Finance and look up that the current stock price in the market is $15 a share. In other words, today this company's stock closed at $15. Wait a minute. I just calculated that the present value based on the company's projections of dividends and growth is $13. Would you buy this stock today? And the answer is no. Why? Why would I buy a stock for $13 when it's already at $15 today? The market is saying this stock is overvalued. Its true value based on the company's projections is 13 bucks. The market says for whatever reason, like Tesla stock, why does the market think Tesla stock is so high? Who knows? The management, the product, the industry, the culture, the public relations, whatever. But the market overvalues the stock. My general rule of thinking today in today's stock market, most of the market is overvalued. It's not worth as much as it's projecting out to be profit-wise. So the answer is no. I would tell my broker, I'm not interested because I think the stock is only worth $13. And if I buy it at $15 a share, I'm not going to make my 12% return. It's not going to happen. But let's say my expected return drops to say 8%. Watch what happens to the stock price. It goes to $26. In other words, if I think my expected return is going to be 8%, that determines the present value under those parameters in the constant growth model of being $26. Now I go to the market and say, whoa, the market says this company is worth 15 bucks. I think it has a value of $26. Would you buy it now? Yes. Why? Because now it's undervalued. The market is missing something. The true value of this stock based on these projections now means it's worth more. This is how Warren Buffett became a billionaire. He picked companies that were undervalued according to his projections, and he bought them when they were cheap. Then finally the market figured out, geez, Warren Buffett was right. This company's doing well. They're making money. They're making my projections. And that's how Warren Buffett became a very wealthy man, by picking those companies that he thought were undervalued. And most people today who make a lot of money in the stock market are buying stocks that they think today are undervalued according to the future. And that's where this constant growth model can be very helpful. Change it back to 12%. And there we go. Pretty nifty, huh? Now, it doesn't mean this is always going to work, but it's a model that's been constantly used in the marketplace to determine the present value of stock. I need you to know that constant growth model. So we've looked at two investments and two sources of capital for corporations: credit or debt bond financing. Most companies borrow money through bonds. Why? A lot of banks can't meet the requirements of lending out to companies. It's too risky for the bank. If a company wants to do bank financing, they got to get a bunch of banks together. That's a pain in the neck. It's too expensive. So that's why most companies borrow money through a bond issue, and then they charge revenue for the services that bond is producing via assets to make the obligations of the interest payments and the maturity. And there we go. Stock, on the other hand, is buying ownership in a company. And your return and the value of the investment is driven by the company's performance. How many dividends are going to be paying? What's the company growing at? What's your expectations of return in today's market? All numbers that can be calculated and provided by either the company or the market. And how does that equate to the current value in the market? Now you know the present value versus what is called the market value. The present value is also for stocks called the intrinsic value, the true value, based on the company's projected results. And remember, every corporation, public corporation, has to give these projections every quarter for the next year. So that's important. And the market value is what the market thinks it's worth. But sometimes the market can be wrong, like I believe today. A lot of stock is overvalued. That's another argument for another time. So you're going to be judging your portfolio based on this. Eventually, we're going to be trying to find the present value of your company stock in your portfolio. And what's the market say about that? We'll be doing that in a couple weeks. So that's bonds and stocks. So this week, week 4, we've learned the definition of bonds and the relationship of interest to their value. Higher interest, lower price value. Lower interest, higher price value. We've learned about stocks, and the true value of the present value of a stock is based on the expectations and projections of a company on the return for their shareholders. Next week, we're going to put this together to talk about finding assets to invest this stock and bond money in. We're going to have to find assets that invest in this money to outperform and provide the funds to pay all these back, to pay back interest and principal, to pay dividends, to pay the projected expected return that an investor wants. That's our discussion next week in 8 and 9. So this week, your graded work is to put together an update of your portfolio as of Friday, October 23rd, and that portfolio spreadsheet, not PDF, not Word doc, but spreadsheet, is due Monday, October 26th. And then we'll talk about chapters 8 and 9 in context with our discussion, and we'll pick this up a little bit more next week in class in my online lecture. But now you have a good start to do your portfolio. Know the definition of bonds and stocks in that spreadsheet provided in your Blackboard week 4. Might be a good idea to start brushing up on chapters 8 and 9, looking at your Blackboard, and you'll be prepared for next week's class and discussion. Sorry again about last night, but I look forward to seeing you all again next Tuesday. We'll talk to you then. Thanks, everybody. Bye bye.